core business of growth farms is buying and managing farmland for investors, and those investors sometimes are Australian, but predominantly they're overseas. Investing in agriculture is a demanding thing to do and to do well. So we sort of want to focus where our expertise is and focus on doing it as well as we can for our investors. The institutional type investors are looking for portfolio diversity, they're looking for more exposure to real assets. One of the attractive things about farmland is that it's got a very low correlation to most other asset classes. So if they're trying to deploy a relatively large amount of money, they want some diversity, particularly with a lot of uncertainty around. And the real asset sector is an interesting sector for them. So it's in land, 80% of their investment is in land typically, and that represents a lot of security for them. It doesn't disappear overnight. At the moment we're sort of managing about 400 mil of assets, Australia dollars, and all of that is pretty much located in the east coast of Australia, so from sort of North Queensland down to the Victorian South Australian border, so sort of a distance of about 3,000 kilometres or thereabouts from one end to the other.
The process we went to find this farm was exhaustive. We looked at 20 to 30 other properties in the area before we decided that this provided us the best value for the client. With the way the property's been developed, we have designed it in such a way that we can generate much more efficient use of labour by using laneways, various different stock handling techniques. So we are aiming to lift our labour efficiency from 8 to 10,000 livestock units per labour unit to 12 to 15. So when we bought the farm, the environmental issues that we were worried about is dry land salinity being the primary concern. As a result, when we went through the CapEx project of refencing the property, we have fenced these areas according to land class, which means it gives us the flexibility then to revegetate those areas to stave off any potential salinity that may develop. Long-term returns we'll get out of the place. We're aiming for between 5 and 7% from operating and a similar return for capital gain. So all up over the investment horizon, we're looking for 12% net of fees.
One of the things that we really like is optionality on the farms. These investments tend to be long-term, 10 years plus. And 10 years can be a long time in commodity markets. So what we like to do is look at farms that give us choice over the long term. So can we go to a higher and better land use? Can we go to something else if there's a major change in the commodity markets and, for example, cereals are doing it tough for whatever reason over the long term? So we like to have choice of enterprises on the farms, and rather than a farm that is just locked into one thing, and it might be locked into beef or locked into sugar or something, we like to be able to move the enterprises in response to long-term trends that we see happening in the market. So since 2008, up to June this year, our track record was a return of just under 10% IRR to investors, and that's coming approximately a third from operating returns and 2/3 from land appreciation. We expect over the long term about 4 to 6% cash and about 6 to 8% land appreciation. And you put those together, you're at quite achievably a 12% after fees. You've just got to do the fundamentals well, and that really means to buy well and then to manage well. You put those two things together, those returns will flow.